Hi everyone, welcome back to the channel. So previously we have discussed question number 1 to 10 of the equity value and enterprise value questions. Today we will be going forward with question number 11 onwards. So without wasting any time further, let's get started. Question number 11 uh, is asking, could a company have a negative equity value and what would that mean? So I see the interviewer asking. And let's carefully unpack this question. Could a company have a negative equity value? What would that mean? And the answer is no, this is not possible because you cannot have a negative share count and you cannot have a negative share price. And after analyzing it step by step. So what does that mean? Equity value, we have previously discussed that equity value formula is equity value is equal to share price into number of shares outstanding. So let me share my screen, my whiteboard on, so that we can discuss this in a detailed way. So equity value is equal to share price and multiplied by number of shares outstanding. And for equity value to be negative, there are two possibilities. Either the share price is negative, and the second possibility is that number of shares outstanding is negative. Either one of them should be negative. Then only equity value could be negative. Share price is the price of one share, and share price cannot be negative uh, because of the usual reasons. Share price cannot be negative, and number of shares outstanding is the total shares issued, and this cannot be negative either because of obvious reasons and because this doesn't make sense that numbers cannot be negative and neither does this price can be negative because both of these cannot be negative. Equity value, in this sense, cannot be negative. So technically, if you are saying that no to this question that it cannot be negative, then you are right. So your statement about negative shares or negative share price is correct. In the standard market capitalization sense, equity value cannot be negative. What can be negative? So book value or book value of equity could be negative. Book value of equity could be negative. And uh, it to be negative, book value of equity could be negative if assets are la- if assets are less than liabilities. This means that if the negative portion is bigger than the assets or the liabilities portion is bigger than the assets, then the book value of equity could be negative. So there is sometimes the question refers to book value. Here it could be negative if liabilities exceed assets. This situation is often called as balance sheet insolvency. So this situation where assets are less and liabilities are more. So it's known as balance sheet insolvency. So negative book value does not mean that shares have a negative price, but it means that the company owes more than it owns. Assets are owns and liabilities are OWES. So there is a difference. Balance sheet in this case, this situation is known as balance sheet insolvency. And the key distinction here is that market equity value is share price into number of shares outstanding, and book value of equity, shareholders' equity is assets minus liabilities. This can be negative, but this cannot be negative. Equity value cannot be negative. And in easier terms, if someone asks you about negative equity value, they might be mixing market value with the book value. If they mean market value, your answer is correct. It cannot be negative. But if they mean book value, if they're asking about book value, so there is a possibility. Uh, yes, so I think this explains this question. Let's move to next question. Question number 12. So, question number 12 is asking, why do we add preferred stock to get enterprise value? So let's break this down step by step. This question is asking, why do we add preferred stock when calculating enterprise value? And for this, we need to understand what enterprise value is. So enterprise value is actually equity value plus debt plus preferred stocks uh, plus other liabilities, minority interest, and then we subtract the cash component out of it. So we have discussed this thing previously. So what is the role of preferred stock? So preferred stock is a type of equity, but it behaves more like debt than common stock. Though the numbers say that it's a stock, but it behaves more like a debt rather than a common stock because there is a fixed dividend payment. Preferred stock receive fixed dividend payment similar to interest on debt, preferred dividend, preferred stock. And second is the priority claim. Just like debt, preferred stock actually also have a, in the event of liquidation, preferred stockholders get paid before common stockholders, but after debt holders. So after debt holders, the preference is given to preferred stock, and then the preference is given to common shareholders, given that there are no other. I mean, this is pretty much the complex structure. So debt first, then preferred stock, then the common stock. Because of these characteristics, preferred stocks are considered as hybrid between debt and equity. But the question was asking, why do we add the preferred stock to enterprise value? So when we are calculating, let me share my whiteboard one more time. So when we are calculating, just give me a moment. Let me just fill in the colors first. So when we are calculating the enterprise value, so the goal is to reflect the total value of the company, what the company owed to all its claimants. So whosoever has a claim on the company, so how much does the company owes to whom? So that is the main role of calculating enterprise value. And how much, if someone actually acquires the company, how much money they will actually have to pay to whom? Using the cash, because when you acquire the company, the cash is also, you actually acquire the cash, you get the cash also of the company. So preferred stockholders, common equity only reflect the value of common shareholders, which ignores obligations like debt and preferred stock. So therefore, to get the equity value, we add debt and preferred stock to get the enterprise value, actually, not the equity value. To get the enterprise value, we add debt and preferred stock and other liabilities because these three actually have a claim on the company cash flows. So that's the main reason we use preferred stock in calculation of the enterprise value. So to get enterprise value of from equity, we add the debt and preferred stock because both are obligations the acquirer will need to settle if they bought the company. And if we think from the perspective of intuition, buying a company means that you take responsibility of paying off its debt and any preferred stock claims. So if you only looked at equity, if you only look at the common equity portion, you are underestimating the true cost to acquire the company. So adding preferred stock ensures enterprise value captures the full economic claim of the company. just like adding debt does. And in one sentence, if I had to explain this, uh, so preferred stock is added to enterprise value because it represents a fixed claim on the company, like debt. And enterprise value aims to measure the total value owed to all capital providers, not just common shareholders. So here in the explanation, it's written preferred stock pays out the fixed dividend, and preferred stockholders also have a higher claim on the company assets than equity investors do. As a result, it is seen as more similar to debt than common stock. And I hope that we have covered everything which explains this question. So preferred stock, even though it's written as a stock, um, but it acts more like a debt because of the two features. First is the fixed dividend claim, dividend claim, fixed dividends, and priority in claim. So after that, preferred stockholders receive in the case of insolvency or in the case of liquidation, and then the equity holders, shareholders, common shareholders actually. Let's move to question number 13 now. So question number 13 talks about uh, how to treat convertible bonds when calculating enterprise value. And to understand it fully, we need to understand few concepts like what is a convertible bond. So convertible bond, we have discussed about this in the previously in the money and out of the money. So convertible bonds are among it's a type of debt that can be converted into a company's common stock at a pre-specified price, which is known as conversion price. And it starts as a bond, convertible bond, but it can turn into equity and also has a dilution impact. So the key point is whether conversion is financially attractive to the bondholder, and if it's financially attractive to the bondholder, then in that case, in the money, the current stock price, if the current stock price is greater than the conversion price, we have previously discussed if you can buy it cheaper from the market, then why will you then only I mean, if you are getting it cheaper than the market, then only it makes sense. If you are not getting it cheaper than the market, then we do not need to exercise the option. And in that case, in the money and out of the money concepts came out. So in the money is current stock price is greater than the conversion price, and out of the money is the current stock price is less than the conversion price. So the bondholder will keep it as debt until then. And the second concept is enterprise value, which we have discussed in detail. Equity value plus debt plus preferred stock plus minority interest and cash. That's how we calculate enterprise value. So enterprise value represents the total value of the company to all capital providers, not just shareholders. So debt is included because enterprise value is the value of the firm before paying off debt. And equity is included because enterprise value is sum of all claims. So debt plus equity. And how now, when we talk about how convertible bonds will affect enterprise value. So if the stock is in the money, so this will increase the number of shares outstanding, which dilutes existing shareholders. So if the stock is in the money, so it will dilute the number of shares, dilute existing shareholders. And enterprise value, you adjust the equity value for dilution instead of counting the bonds at debt. So you do not include the bond as a debt because it's no longer really a claim to the company. It's no longer a claim that a company owes in cash. And if the stock is out of the money, there is no you do not need to worry about anything because there will be no dilution impact. It stays as a debt only, and you count the face value of the bond as debt in the enterprise value formula. But if the convertible bond is being converted, then the debt will go off, the debt will go off, and it will impact the dilution. Previously, we have done a question regarding this thing. Um, and as of now, we do not have any example, but I think the next few questions we will have a question. We will have an example regarding enterprise value using convertible bonds and debt. So, and if by reading the definition here, by reading the explanation here in the convertible bond, if the convertible bonds are in the money, meaning that the conversion price of the bond is below the current market price, then you count them as an additional dilution to the equity value. If they are out of the money, then you count the face value of the convertibles as a part of company's debt only. So once the debt is converted into convertible bond, the enterprise value actually decreases because the debt is now converted and it's now diluting the common shareholders' equity, the number of shares owned by common shareholders. Let's move to question number 14 and see if, okay, we do have a question here. A company has 1 million shares outstanding at a value of 100 per share, and it also has 10 million of convertible bonds with par value of 100 and conversion price of 50. How do I calculate diluted shares outstanding? And we have done a question similar to this previously also. So here in this question, we have 10 millions of convertible bonds. Par value is 100 and conversion price is 50 and company's share price is 100. Conversion price is 50 and company share price is 100. This means the share price is greater than conversion price, and this states that it is in the money, because it does make sense that I can buy something worth 100 for 50 rupees, $50. So the current share price is 100 and the conversion price is 50, and I have 1,000. It has 10 millions of convertible bonds, $10 million of convertible bond with par value of 1,000. So if the par value is 1,000 and conversion price is 50, how do I calculate the shares outstanding? So they are asking you to calculate a diluted share outstanding. So convertible bonds can be converted into shares as a fixed price, which is called the conversion price. If the stock price is above the conversion price, the bondholders are likely to convert, and this is the case here in the money. And dilution is basic shares. 1 million shares were already there, and the new shares, the diluted shares outstanding will be basic shares plus the new shares, which will be formed in the money convertibles. So, how many bonds are there? The question. We have $10 million of convertible bond with 1,000 value, $1,000 par value of 1,000. So we will divide 10 million by 1,000, and this will give us 10,000 bonds. Let me just give me a moment, and I will just show you. So how do we calculate? We have total value of bond is 10 million, and each bond has a value of 1,000. So how do we, to calculate number of bonds? We will divide 10 million by 1,000. So we have 10,000 bonds. And how many shares per bond? So we can calculate 20 shares per bond by dividing by 50. To total number of conversion price is 50, and we have 1,000 par value, no, 1,000 per par value. So we have 20 shares per bond. So this is how we calculate the total number of 20 shares per bond. We had calculated how many shares are there with one bond. So we will multiply 10,000 with 20. So this will give us 2,000 shares. So to calculate the total number of new shares which will be formed by using exercising the option, so we will have 200,000 shares in the market. But to get the basic shares, if the company originally had 1 million shares, and now we have company originally had 1 million shares, and the diluted number of shares outstanding will be 1 million plus 200,000. So there will be 1200. So the new share count will be 1,200. 1 million, 1.2 million, 1 million, 1.2 million shares. So this will give us 1.2 million of shares. So let's read the explanation given by the company. This gets confusing because of different units involved. So first we need to convert. First we need first note that these convertible bonds are in the money because the company's share price is 100, but the conversion price is 50. So we can count them as an additional shares rather than debt. So we need to divide for we actually need to find the bond. So the number of shares, because here number of shares are not mentioned. It's mentioned that 10 million convertible bond, then the par value per bond. So if I divide the 10 million by 1,000, so I will receive 10,000 bonds, and conversion price per bond is 50, and number of shares I have to find, if I have to find is, so I will divide 1,000 by 50, so I will receive how many number of shares can I buy with one bond. So it was 20, and when I multiply 20 with the number of total uh, c- convertible, how many bonds I have, so 10,000 into 20 is 200,000. So 200,000 new shares will be created by exercising the convertible bond. I hope this was clear. So let's move to question number 15, the final question of this reading, the basic questions. And after that, we have advanced questions, which are only three: enterprise and equity value advanced questions. So what is the difference between equity value and shareholders equity? So equity value and shareholders equity. So what is the difference? So equity value is the market value and shareholders equity is the book value. Book value will be book value is given on the balance sheet, and equity value is calculated by number of shares into current market value of one share. So equity value can never be negative because share outstanding and share prices can never be negative, whereas shareholders' equity could be any value. For healthy companies, equity value usually far exceeds shareholders' equity. And we have discussed about this, that equity value can never be negative, but yes, shareholders' equity or the book value of the equity could be negative in case of balance sheet insolvency. And that scenario is called balance sheet insolvency. And if the asset value is greater than the if the liabilities are more than the assets. So we have completed the 15 basic questions of enterprise value and enterprise value and equity value. So get started with the remaining questions of the advanced enterprise and enterprise equity value questions. So okay, so here there is this concept where the enterprise value is asking the question, the interviewer is asking to the candidate about the enterprise value formula if there is something missing. So let's break down this carefully so that you can understand both question and answer. So this is asking whether the standard simplified enterprise value formula might be incomplete or inaccurate in some situations. And yes, The standard basic formula was enterprise value is equal to equity value, equity value, and we subtract cash. Then we add debt, preferred stock, and non-controlling stock. But in practice, net operating loss uh, is also used, and LTN equity investments, long-term investments, and long-term equity investments and long-term debt investments are also used. Capital leases and unfunded pension obligations are also used. So the additional adjustments might be needed for more precise EV calculation here. So net operating losses are actually companies sometimes have tax losses that can be carried forward. So net operating losses are those losses. These are the value. These are valuable because they reduce future taxes. Adjustments. We add the value of net operating loss similar to how we add cash. So the net operating losses are actually added back. So I mean, just the way they are treated as same the way we add cash to the company. I mean, we use net operating losses, so we subtract them. So this is cash, the provision or howsoever we treat this. So we actually subtract it because it is useful to us, just like cash and long-term equity, long-term debt and equity investments also. So investments in bond securities uh, and other long-term assets can be converted into cash if needed. So we also use them like cash only. So we subtract them. And equity investment in other companies. Equity investment in other companies, if a company owns part of another company, it's an asset. So sometimes discounted depending on liquidity. So we adjust them by adding so equity value and the long-term equity investments. So if we have invested in some other company, we use them. We add them back just like cash. We treat them like just like cash. We subtract them. We dissolve those in these investments so that it could be helpful to acquire the company. Capital leases are there. So capital leases are like debt only. So capital leases are long-term lease obligations that function like debt because company must make payments. So we add them just like debt. So we will treat them just like debt. And operating leases and capital leases and operating leases. So capital leases are a part of balance sheet. And operating leases normally do not go to the balance sheet, but sometimes you convert them to capital leases for consistency. So um, we convert leases as debt. So either it's capital lease or operating lease, we will convert this as debt only. And about the unfunded pension obligations. So if a company owes pensions that are not funded, it's essentially a liability. So uh, we will treat this portion unfunded pension obligation as debt only. So the more correct formula of enterprise value would be equity value, cash. We subtract cash, we add debt, preferred stock, non-controlling stock, and till now we know this. We have till now we have done this much formula, but now the net operating loss and the long-term debt and equity investments, we subtract these also. We add back capital lease and capital leases and unfunded pension obligations, and we will treat these as debt only. So in interview, usually you cannot get away with saying enterprise value is equity value minus cash plus debt plus preferred stock plus non-controlling interest because uh, this is more advanced interview questions, and in practical and in theory there's a difference. So in practice, when we are valuing a company's enterprise value or we are calculating an organization's enterprise value, the net operating losses, long-term investment in long-term investment, equity investment, capital leases, operating leases, and unfunded pension obligations, these numbers are also important. So what they are actually testing here is whether you understand the simple EV formula is oversimplified. The real companies have extra assets and liabilities that can affect enterprise value, and advanced formula account for those on. And by knowing the extra adjustment shows that you have advanced understanding. And if they push you further, you can mention net operating loss and investments and leases and pensions also. So this is very good. This is a very good question. And enterprise value is an important metric of a organization. So I will suggest you to read a little more about enterprise value, these terms on net operating losses, long-term investments, equity investment, capital leases and operating leases, and unfunded pension obligation. And why do we collect these data? This data also. Okay, so let's move to question number two of advanced questions. So, should you use the book value or market value of each item when calculating enterprise value? So, let's break down this carefully. So, enterprise value we have discussed equity value plus debt plus preferred stock plus minority interest minus cash and cash equivalent. And now, when we have seen the formula, we subtract net operating losses, we subtract long-term debt and equity investments, we add back capital leases and unfunded pension obligations. So technically, enterprise value is meant to represent the market value of the company's entire capital structure. That means, in perfect word, everything, equity, debt, and preferred stock, etc., should be at market value. So practically, equity value uses market value, debt, preferred stock, minority stock. Hard to get the precise market value, so analysts often use book values. So, and debt, preferred stock, and non-controlling interest. Analysts actually use book value of these. And so, cash is usually taken from the balance sheet, which is generally close to the market value. So, in summary, we use market value wherever we can. For components where market value is unavailable or impractical to estimate, book value from the balance sheet is accepted. This is why in most of the real world enterprise value calculation, only the enterprise value is strictly market based. So enterprise value is strictly market based and the rest relies on the balance sheet figures. So technically you should use market value for everything. In practice, however, you usually use market value only for equity value portion because it's almost impossible to establish market value for the rest of the items on in the formula. So you just take the numbers from the company's balance sheet. And also companies report these numbers, the cash, unfunded public pension obligation, capital leases, long-term and equity investments and not net operating losses. So companies actually report out these numbers also, other than in the company's financial notes. So equity value, we strictly follow the market value, and the cash is taken from balance sheet. Debt, preferred stock, and non-controlling interest, we actually rely on the. It's very difficult to get the current is the market value, so we rely on the balance sheet numbers only. But in the company statements, they actually also report in the notes section the debt, current value of debt. I think no, the current value of debt is not reported, but the balance sheet value of the debt and the structure is reported. The preferred stock, the debt, and is the what I'm trying to say is the market value is not reported to the balance sheet numbers. We rely on the balance sheet numbers only. And this was actually this second question was also a very good question. So this involves deep thinking. And question number one and question number two, both were great questions. And uh, knowing these questions show that you actually have a very good understanding of the finance concepts. Let's move to question number three, the final question. What percentage dilution in equity value is too high? So, equity value is the value of the company's shareholders' equity, the total value of all shares. And the diluted equity value accounts for potential future shares that could be issued, such as stock options granted to employees, convertible debts, warrants, other instruments that could convert into shares. So dilution of equity will be done by these four: ESOPs, convertible debt, warrants, and other options, which other instruments, not options, which could be converted into shares. So dilution actually occurs when these potential shares are factored in, because issuing them reduces the ownership percentage of the equity, existing equity shareholders. So there is no strict rule, but more than 10% is considered unusual for more companies. 10% is more considered unusual for most companies. Like example, a basic equity value was 100 and basic diluted equity value is 115. So if we substitute these in and we try to calculate this, so it's more than 10%. And in simple terms, 15% is higher than normal. 10% dilution is unusual and may require double checking your numbers, and it is not necessarily wrong. It is not necessarily wrong. Some companies, especially startups with lot of options of convertible instruments, have high dilution. But for a mature company, 10 to 10% would be a red flag, and 15% will be definitely a red flag, indicating that many potential shares are outstanding and will be issued. So 10% or 15% is a very, very high number. And dilution is a measure of how much equity value increases when potential shares are included. So potential shares means which could be added. And most bankers treat 10% dilution as high, more than 10% as a high dilution as a high. This is a red flag. And always check why the dilution is high. Stock options, warrants, and convertible debt. So that is why the uh, you actually should have a knowledge about the company's capital structure. So how they have raised money, how much money they have raised in past, and yes, all these things. So 10% is high, and above 10% is a red flag. All right. So we are done with our enterprise value and equity value advanced questions. So these three questions were really good questions, and it involved a very deep thinking, and uh, knowing these questions will uh, show that you actually have a very good grasp on finance concepts. Um, so I will conclude today's session here only. So let's meet in next session where we will be discussing about the valuation questions and answers. Basic, there are 34 questions, and then the valuation question and answer advance. Um, so all the very best. See you soon. Thank you.